right. Now I should be able to share desktop one. Boom. Can you guys see?
Yep.
All right, perfect. Okay, so Chen came to me and said that you guys had an interest in Elliott Wave and Gann theory. And that's a big question that I'm not going to have time to address fully in 40 minutes or so, because I want to open up the last part for questions and all that. In fact, Elliott Wave alone came from a one specific module that was designed for a 3-hour period. So you can see how the module is laid out. We go over something called cipher patterns, which leads into Elliott Wave, and then we have some other stuff here. So the way I'm going to do it is this. I'm going to give you guys kind of like the meat of Elliott Wave theory, because I think that that's all that we're going to be able to get into. If you guys like this, I'm going to go deeper, right? Because this was not designed to be an encyclopedic treatment of Elliott Wave theory, and nor could it be in the time I have. So I'm going to leave it up to you guys. If you guys like this kind of thing and you want to hear more of it, by all means, let me and Chen know. If you don't, that's cool too. And, we could just reallocate other material to you guys. Gann theory, I'm going to have to, reserve that for a later time, but I'll keep it on the radar for you guys. We might do one of our little impromptu sessions on it, or I can chime in and do it, tag team one of the classes, with Chen some other time. But for the moment, we're just going to start off with Elliott Wave, and I usually like to begin it. So I hope that's, okay with you guys. I'm going to do my best to cover as much in the time that I have in order to give you the best treatment of the topic. But the way I like to start it, the lecture on Elliott Wave, is actually with two simpler patterns, if you will, that become the core components of Elliott Wave, right? Because this is a very, it's I don't want to say it's complicated. It does take a lot of practice, but it's, it aggregates things, right? It aggregates information. So you keep, once you have one thing, you add to it, and so forth. And you're going to see that in a lot of examples. So I hope that wasn't too confusing. Because if anything, I think that it should be motivating, because this is the type of skill that if you get good at it, there are many ways to make money and to do trading off of it. So the first one, where I'm going to start with this, I skipped over the cipher patterns. Again, if you guys like this kind of thing, let me know, and we'll schedule in to discuss the cipher patterns, because I've used them in trading. They're very accurate, but they do take a little bit of getting used to. And me and Chen are always very honest about this. We're going to teach you like the floodgates, right? It's like learning from a fire hose, and you're not going to be able to use every single thing we teach you, but the things that you do, we want you to get really good at. So this is one thing that but if you get really good at it, both Elliott Wave and these cipher patterns, you can be very successful with it. So where I like to start is what we call the Wolfe Wave. And the reason why it's called a wave, is going to become very clear to you in a second, but it's what we call a 5-pointed pattern. And so, I skipped over these cipher patterns, but basically, as you see, they have 1, 2, 3, 4, 5 distinct points, and the vertices that connect them have some significance in the trade. Well, the Wolfe Wave is very similar, but I'm going to jump right into it for reasons that'll be clear to you at the end. And it's what we call a zigzag pattern. So basically, if you picture in your mind what a zigzag looks like, it's that. It's a little bit of nuances, but basically just so you have an idea. And this pattern is really cool because the entry and the exit are built in. Okay, I'm going to repeat that. When you draw this pattern, the entry and the exit are spelled out for you. Okay, again, trading is, never 100%, but I mean, this is a very high probability pattern, and I've had that actually verified by quant traders other than me. So when you believe it, you see it, and other people see it too, you have reason to believe, okay, there might be onto something, right? So again, I specify that what's cool about this is that the entry and the exit are spelled out for you, whereas the other patterns are more general, right? We've been seeing that in Chen's lectures, and I stress this too, is they kind of tell you when something's going to happen. A lot of times they don't even tell you if it's up or down. You just kind of have to wing it, look at your levels and all that. But this has that added benefit. it is based on trend lines connecting certain vertices. Again, this goes back to the 5-pointed nature of the pattern. And it's pretty reliable at all time frames, which is another characteristic that's that is not necessarily shared with some of the other patterns, because sometimes volatility on shorter time frames will give you the illusion of like a wedge or something like that, but it's really just random noise. Whereas this is fairly reliable at all time frames. So any questions so far on my approach to this, or any preconceived notions about Elliott Wave you want to clear up, or?
Oh, no.
All right.
Good.
Awesome. Good to hear. Okay. So there is a bullish and a bearish version of this. So we have, we're first going to start with the bullish. Now, what you may notice from this graph is that, let's see if I can move this. Okay. Put this up here. The little zoom thing is right in my way. I don't know if you can see that, but so we have this downward trajectory here. So why would it be bullish? This is a bullish trade if my trend is downward, and that's going to, you're going to really see that when we get into Elliott Wave, why that is, right? So again, don't be confused by the fact that this is clearly a downward, like bear channel type thing, but yet it's a bullish trade, because that'll be clear to you when we talk about Elliott Wave. But anyway, how you construct it, you take these 5 points, right? There's a leg going down here, a retracement, another leg going down, a retracement, and then let's move this 5 over. I recently redid the slides in the Go Squawk format, to try to rebrand everything. So sometimes the charts aren't as nice as I'd like them to be, because I haven't taught off these slides before. But anyway, so is everybody clear on this 1, 2, 3, 4, 5 pattern? And if you're not, don't worry, because we're going to go over a bunch of examples, but it's really contingent. Everything from here on out is contingent upon us understanding that we have this 1, 2, 3, 4, 5 downward zigzag pattern, or in the bearish case, we'll see it's upward, but 5 points, and you connect them with lines is basically the gist of this. Now, here's where it gets interesting, right? Because based off of this, I'm going to be drawing some trend lines, okay? As you see, there are 2 of them, and those trend lines are very important. Their use is helping me determine where to enter and where to exit the trade. Because remember, I told you that there was a the strength of the Wolfe Wave was the fact that it's it has the profit target and stop loss, or sorry, the profit target and entry price built in. So how we connect, or how we determine the entry price, is basically we have 1 through 3, right? We see this line connecting here. Okay, it's just a line segment that connects 1 and 3. The profit target is ascertained by connecting 1 and 4. All right. So to repeat, we connect these 2 points here, the 1 and the 3, and we get our entry. We connect 1 and 4, and we get the profit target. Now, why am I? So I noticed that if you notice here, this line connects 1 and 3. So I could have easily entered here or here. Why is the red arrow pointing at entry at this? Okay, it's not because it's my modules and I just know that it's going to turn around because I designed the graph. It's because there's a trend. This guy can go as far as he wants, right? But until it comes back and it intersects with this line, we don't consider it to be a trade. If you do, that's fine, because a lot of times we have bounces off of this trend line. So just to draw that real quick, we could have this, right? So if you enter on this point here and it doesn't go your way, you just know that you have to account for that with your stop loss. And how would you calculate that? We'll get into the details of that in a little bit, but again, it goes down to risk reward, right? So if I see that if I enter here or here and my profit target is way up here, then I have to calculate, roughly 1/3 of that for an idea for a stop loss. So is that clear so far? I know I just threw a lot of stuff at you, but it should
I'm
be.
carrying along fine.
Okay, good. It should be clear with some examples. So again, we have this. This is the bearish case. We have the 1, 2, 3, 4, 5, right? We have our entry connected by this, these two, again, 1 and 3 give us the entry. 1 and 4 give us the profit target. Now here in this case, I have it drawn where we, hypothetically entered a trade right on this trend line. That's perfectly fine. You just have to be aware of the risks. Okay, so just worked out the way I drew it. But just to give you an idea, again, 1 and 3 give you entry, 1 and 4 give you profit target. So that's the bullish and bearish version. Again, note that this is actually going against the trend, right? Because with the bullish, we had a bear trend, and we're buying at the bottom here. Whereas with the with the bearish trade, we have a bull trend, and we're playing on this reversal here. All right. So some examples, we see this is a 5-minute chart. I used to trade a lot of currencies, so a lot of these are old slides from trades I've actually made that with weird pairings like euro against GBP and whatnot. But anyway, so we have it's not so easily spelled out here, but we have this uptrend here, 2, 3, 4, 5, right? 1 and 3 are connected here. 1 and 4 are connected here. I wish. Let's see. Well, let me fix this real quick. Spell it out a little better. The wave. So you see what's going on. One, two, three. Yep. So again, you see how the zigzag is working. We have this 1, 2, 3, 4, 5. This is also, I use Heikinashi on this, and this is just a pro tip, and I'll make a note of this somewhere in the slides, is that sometimes the Heikinashi makes it a lot easier for you to identify these legs, right? These vertices here. So notice with the Heikinashi, even though we have some volatility here on the wicks, we can see these clearly defined trends, which is really what you want when you when you're working with this type of trading analysis. So it's just a pro tip. And again, what makes you, with any of this, what makes you successful is practice, right? So ideally, if this is the type of thing that you'd want to trade, you do some examples and see for yourself. But again, we have the 1, 2, 3, 4, 5. 1 and 3 give us the entry. 1 and 4 give us the profit target. This is a little bit cleaner example. I try to stick with the messier examples first. This is the US dollar against the Swiss franc. So here we clearly have a bullish trade, and here I did a little bit better job with the graph, right? So I have, you see this vertex here is 1, then we go to 2, 3, 4, 5. This is actually a 1-minute chart. They're not exactly perfectly aligned to this because I think I did it on a 3-minute chart and zoomed in. But either way, the veracity, that is the truth, the trade still holds. That we're roughly connecting. No, I guess that's not correct. I'm still connecting these here. So 1 and 3 gives us the entry way down here. 1 and 4 gives us the profit target, and we see that we hit it.
Hey, that's interesting, man. I've only seen Elliott Wave being applied on like really like large time frame.
No. Elliott Wave is supposed to work at all time frames, including like seconds,
really?
Yeah.
Wow. I've always shunned away from using like Elliott Wave, things like that in like 1 minute, 3 minutes.
That is, it's a good. I mean, in general, you know as well as I do that you're obviously incurring more risk when you do that, right? Because you are, shorter time frame, more volatility, the drill, right? But if you can see these clearly defined patterns and are able to draw these, these accurate vertices, The same analysis is going to hold. If I was to put this to 5-minute, it would just squish the chart a little bit, right?
Right.
I'm not doing these on like individual bars. That would be kind of dumb. I'm doing these on larger aggregations of the bars, because here's the thing, like one thing, and you know, Chen and I have this discussion all the time, is that it's like there's really no 100% confirmation of when you pull the trigger, right? So a lot of this analysis was gained for me as a new trader. This was some of these charts were when I was first starting to trade currencies anyway. That's why you see a lot of currency examples. But it's like I would draw out the pattern and whatever it was and be like, fuck, is it now do I pull the trigger, do I place the order now? And these type of patterns really help build confidence in being able to take that trade. But to reiterate, Elliott Wave works on all levels, you know, as far down as you can go, but it is, as with any technical pattern, more accurate the larger you go.
Larger. All right, that's perfect, man. As I'm sorry to interrupt you. I was mentioning to Andy and Andrew earlier, like I personally don't use Elliott Wave in my own trading, and I always thought that Elliott Wave and technical indicators in general were more accurate on a larger time frame. And so so I would shun away from using this type of analysis for intraday trading. You know what I mean?
It's actually the opposite for this. So I would agree with you with every single technical indicator other than this, because there's a psychological component to Elliott Wave, even though technically we're still talking about the Wolfe Wave. Let me make sure we have time. We're still talking about the Wolfe Wave. Yeah, we have time. But it's based on Elliott Wave kind of theory. So these are actually better on intraday time frames because they're driven by psychology. Whereas all the other patterns are based on levels and you know, technicals and all that. This is based on psychology. So these are trends that people do, and there's reasons for it. We'll show you some of that. And basically, there's this, and this is why we tell you to buy on dips, right? Because you have this craze of buying, then people take profits or get stopped out on the shorts. Then you have a retracement. Then you buy in and you get this zigzag kind of pattern. Well, eventually that itself gets exhausted, and then you have a retracement. So we're going to see that in a second. But let me just go through with the Fibonacci's really quick, because if you have, with any pattern, if you can stack reasons to, you know, facts, right? Reasons to believe that you have a good trade, the more the better, right? The more tools in your toolkit. So confirmation of the pattern is done a lot of times by the Fibonacci levels. So this is really important. The vertices should align with the Fibonacci levels, right? So as you see here, this goes back to my USD Swiss franc trade, and you see we have these vertices basically perfectly aligning with the Fibonacci. So based on how I've anchored those. So if you want more confirmation that your Wolfe Wave is done correctly, go with the Fibonacci's. And here's just basically going back through other examples and showing that. This is a good one with the USD against the Japanese yen. Again, I'm using the Heikinashi charts because even on 30-minute, the USD against the Japanese dollar does not look this pretty as Chen can. I'm sure you agree. So here's again, I like to show you the theory and show you some examples that I know did work, but also to show you examples of screenshots I've taken of trades that I've placed that I've done this pattern with. So I'm sure there's probably a way to fake this, but you know, take my word for it. Like I actually drew this and I went into the trade, and you know, this is a before and after of what the thing did based on the Wolfe Wave. All right. Any questions so far?
You're covering it good.
I'm sorry?
You're doing it good, don't worry.
Okay, cool. So it is prone to failure. Usually, at least like one person laughs off of this one. And that is when, you know, there's a couple reasons why this one failed. You know, well, first of all, this isn't, if you just look at it, it doesn't have very good alignment with the Fibonacci's, right? But the main reason why it failed was because I didn't wait. And yes, I did take this trade. So I'm having you guys learn from my mistakes. But you see, 1 and 3 should be my entry price, right? I was trying to preemptively jump it here to ride this retracement when I should have been waiting patiently for it to hit this trend line. Okay, that's very important that you understand that. Don't try to jump the gun and force the pattern to happen. The trade happens because you see the pattern, not the other way around. Not because you're trying to force that pattern to happen, which I did here. So don't do that. Right. So again, 2 reasons why it failed. First is because these vertices don't align very well with my Fibonacci's, and the second reason is I didn't even go about the trade in the own theory that I should know, which is to wait until this guy retraces to this trend line and buy it back down here, right? I went for the bearish trade off of a bullish pattern. So 2 reasons why I got fucked on that one. And also, if we had time to go over what this was, this is a very bullish pattern, right? And this one is more accurate, way more so than my shoddily drawn Wolfe Wave here that I was trying to force when it wasn't there. So again, that's a 3rd reason why this trade didn't work out. I'm going to skip over the ABCD pattern because it's a component of Elliott Wave anyway, and I feel that the Wolfe Wave was a little bit, yeah, I'm doing this out of time interest anyway. If you want, you can go through it in the module, or I can devote a module to it for you guys if you guys like this kind of thing. But just suffice it to say, if you want to go read about it on your own, we always provide you the modules. And there's plenty of information about it if you Google around for it. But again, we'll be very pleased to show you if you show interest in this. But there's a lot of examples where this pattern did work very well, and it's a very simple pattern too. Okay, so let's. All right. Okay, so let's go. Without further ado, we'll check out Elliott Wave Theory. Okay, so I know that this was something you guys have been asking about for a little bit, and it's something that I use actively in trading, even if I don't actually base the trades 100% off of it. It gives me an idea of where the markets will go, and Chen can attest to this because we talk about the markets all the time, and I'll be very quick to point out the Elliott Wave and where I think it's going to go. And so the core principle about this theory is actually quite simple, and that is that markets move in what we call impulses, which are into the trend, right? They're toward the trend, and corrections, which are against the trend. So remember, I told you guys, you never ever just see something just rocketing up, right? Even the most aggressively bullish stocks still have pullbacks, right? Because eventually people run out of money, right? They either run out of money to buy and the stock kind of stagnates for a little bit, or they want to take their profits and they sell. So you're going to eventually see, a little bit of a pullback. It just really depends on where and why that happens. So another tenet is that these are fractal in nature. Now, you see fractals all the time in trading. And if you remember what I told you guys before about why that happens, is that the fractal nature of finance is simply because price is related to itself in the past, right? If I have a stock and it's trading at $100, I'm probably not going to see it go to $5 unless something really bad happened. I'm probably also not going to see it go to like 300 unless it's Tilray, right? But we saw what happened to them later. So the point is, it's the price is always related to itself in the past, just by pure numbers, right? So it would be reasonable to say that the stock might go to 101 or 105 or something like that, but not as reasonable to say it's going to go to like 1,000 overnight. So that type of constraint basically forces a fractal nature or a self-referential nature in what we're dealing with. So, when you do some analysis on this, and there's a really great book on this written by Elliott himself. That was the first book written in like 1920. It was like 200 or 300 pages, and it went into more the details of why these are the way that they are. In general, we are dealing with, or at least there's basically 2 classifications of them. I'm only going to go over one. So this Elliott wave assumes that we're in a trend, either bullish or bearish. There is a side wave Elliott wave pattern, and I can, teach you guys that if there's interest, but just I could literally design a whole course around Elliott Wave Theory alone. So we're just going to deal with the 50,000 foot view. So impulses, again, those are the things into the trend. If we're bullish, those are going to be bull runs, and bearish, the converse. There are 5 segments, and we call those segments waves. And corrections, we have 3. So the above is an example of a 5-3 wave. And again, it can be found on any chart regardless of time frame. Now, of course, there are scenarios that lead you to be more confident in the in your assessment of the veracity of the Elliott wave, and we're going to go over those. All right. So one thing I do have to make very clear is that there is a high degree of subjectivity to this. So as I've stressed with some of the other things, like Fibonacci's is a great example. It's an art and a science. The science part is derived from very solid math. It's been around since like the 1600s. I mean, Fibonacci sequences have been around for, as early as modern math has really existed. But the art comes into identifying those anchor points. And I hope you guys have been practicing that, because it's one of the most powerful tools in trading. And we're going to build upon it here. These aren't concepts that you forget, right? That we just shelve. They're concepts that you build upon, that we treat again and again and again. So because of that degree of subjectivity, it can be difficult for beginners or even experts. And this is important to understand, that 2 Elliott wave practitioners will generally not draw the same waves, but hopefully they actually come to the same conclusions. And so don't worry if you saw something necessarily that I didn't, or that if you would have drawn it a certain way and I drew it differently, or if my analysis conflicts with yours, because the details of, say, those vertices, that 1, 2, 3, 4, 5 thing, that's not really important as much as the direction and the knowledge you're gaining about the direction of the markets from that. Okay. So how do we, okay, so a little bit more about the trends. So again, these things are fractal in nature. So we start with the largest granularity or degree. That's usually at like day or week or even month level charts. And that's the largest. The furthest you can zoom out is called the grand super cycle. Now, don't worry about actually, I might even skip this. The nomenclature isn't really that important because we typically, the notation exists for you to have 12 of these at the same time. But what I mean 12 of these at the same time is the fact that if you see an Elliott wave and you zoom in, you're going to see other little Elliott waves within that. That's what I mean by fractal. What a fractal is something that you look at and the whole thing bears traits of its components, right? So in other words, an individual set is going to be reflected in itself and the whole picture. Okay, so what I mean by that is that these waves nest within each other. So this is a basic drawing of a basic Elliott wave pattern. We have 1, 2, 3, 4, 5, 1, 2, 3. Okay, those are what we call the waves. Now, if you zoom in on this, you're going to see something like this: 1, 2, 3, 4, 5, 1, 2, 3. So notice what we're doing is we're basically taking this whole thing and jamming it into one of these legs, right? So again, this whole pattern should be able to be representable in each of these legs. Okay, does that make sense? So if we go even further, we should be able to see it represented in these. So again, if I take this tiny little thing, I should be able to see that 1, 2, 3, 4, 5, 1, 2, 3 within it, and every single subsequent one after that. So does that make sense so far, the self-referential nature of this and the fractals and all that?
Yeah.
Okay, cool. So I'm going to actually reword these last two. I realized reading it over myself, they made no sense. So let's just focus on these two, and I'm gonna graphically demonstrate to you what I mean by these two rules here. So we have wave 1 starts the trend, and it's usually a correction from a trend before. So that is, we have a downtrend and say suddenly we have a bullish reversal. That's going to be your wave one, right? The thing that starts the trend. And wave three can't be the the wave three can't be the shortest. I have here that it's supposed to be the longest and strongest. That's what you usually see, but you could also see it in wave five or wave one. It's just a little bit more rare. This is typically what happens. Again, this is more of a very general, high-level view of Elliott Wave Theory. I didn't really get a chance to go into all the details and exceptions and nuances and all that, but if you are interested, I can tell you. Notational conventions, this is the only thing I'm going to go over, is the impulse is usually done in 1, 2, 3, 4, 5. The corrective is ABC. If you guys really get a hard on for this and you really want to dig deeper into it, the notation, actually, I said 12 earlier. Excuse me, that was an error. It's actually 9. But this is all. Yeah, go ahead.
Yeah, sorry to interrupt you. Guys, I just dropped a video linked from YouTube on sacred geometry. So it has a lot to do with fractals and the whole Elliott wave nature of what Danny's talking about.
That's a very good one, Jen. Thank you for that, because that I highly recommend you take a look at that, even if not for trading, just for like learning about reality in general, how it works.
Yeah, it's also good if you want to get on some like LSD or something, because it's very
sure.
very very trippy stuff.
Yeah, no, like I've studied quantum theory and quantum field theory and particle physics and all this. So the very fundamental fabric of the universe is based off of this shit. So
it's based off of the fractals, right?
Yep.
Yeah.
Exactly. And the ratios that you get between these numbers and stuff. So of course it's a subset, it's a component of physical reality. I would argue that it's fundamental to physical reality. So of course you're going to see it in trading. So
absolutely. Yeah. You guys check out that video that I posted for you. It doesn't talk about trading, but it talks about the fractal concepts that Danny's discussing, and how we take this information and apply it to trading, right? As like traders, like we take that stuff, but that's really where the mathematics behind the concept that Danny's talking about comes from.
Yeah, exactly. It's a very good. It's like an hour or two or something like that. It's a documentary.
It's a 2-part video. If you guys like it, you can watch part 2. If I just dropped it there. It's like 9 minutes, right? If you like it, move on to part 2. If you don't.
I thought it was a documentary. I thought it was longer.
Maybe I'll try to pull that one up. I think I know which one you're talking about.
Yeah.
Pull that one up.
It's that one that I'm talking about, the longer one. But now that I know that, those ones are good too. It's like a very high level. Yeah. Anyway, just watch it.
Yeah, exactly. Yes. Sorry to interrupt you. So yeah. Go on.
Not a problem, buddy. That was actually a very good interruption, because if you're kind of lost or you want more information about what I'm talking about and how it applies to not just trading but physical reality itself, it's a really good thing to watch. But I'm not going to go into the notation because, as I said, we have the notational tools to deal with basically 9 levels. But really, the only one that we care about is this one right here. Because if you guys want to get into, zooming in and doing the fractal stuff, by all means, get into it. I'll be happy to give you the tools to do that. But in practice, basically, we just use 1, 2, 3, 4, 5 for for what we call the working degree. That's the trade that I'm looking at. And if I'm zooming in, I'm going to use little Roman numerals. If I'm zooming out and I want to see the thing that's a component of, I'll use big Roman numerals. But again, and then of course the little letters here and here. Don't worry about that so much. Just when I use this notation, I want you guys to know what I'm talking about. Again, if you want to get into it, you could do that. Learn more about that yourself. I just wanted you to be prepared. If you see on my charts to see some weird Roman numerals action, you would know what it meant. So what that boils down to is this. Okay, so I have the 1, 2, 3, 4, 5. This is how you're going to draw it. And you have the A, B, C. Okay, so 1, 2, 3, 4, 5. 1, 2, 3 is just denoted by A, B, C. Okay. Now, when we zoom in, you can see the Roman numeral stuff going on, but we probably won't have time to deal with that. So again, this is a chart with SPY. Again, that's the ETF that tracks the S&P 500. And we have the first leg here going to 1, then we have this reversal that forms 2. All this big drive here forms 3, and then we go to 4 and then 5. Okay, that's a basic example of an Elliott wave. Now, if you look, you could see different opportunities for me to say, why is it that I chose this one for 3, not this one or this one? And I'm going to get to that in a second. There's some pretty good reasons why you would do it that way. But first, let me just go over some of the basics. All right, and I guess this is the reason that I was thinking about right here, is that notice I have this 1, 2, 3, 4, 5. Well, guess what I have here, right? 1, 2, 3, 4, 5, 1, 2, 3. Okay, and this is on a day level, so you can pretty much be pretty confident that this is something that's reliable. Now, if you wanted to zoom in here, I can see it right now. We have 1, 2, 3, 4, 5, 1, 2, 3. So you will be able to see them on these levels too. It's just as most apparent on this right here, which is why I chose this example. Let's see, this is an example with oil. This is, remember I told you that these often, you could stack these charting techniques and get one or multiple trades. Chen had a good example when I first joined about the double top and double bottom, and that's really corresponded with the Fibonacci's and all that. And it was just really perfect analysis of what I'm trying to express to you guys. It's just mine are going to be a little bit different than his, right? So I use these weird cipher patterns and things like that, and combining that with Elliott Wave, we see that we could short in here, right, and pick up a trade here if we're confident in our Elliott Wave analysis and be prepared for what's going to happen over here. Sticking with this example and zooming in a little bit, again, we see that nested fractal nature, and I guarantee you if I zoomed in here, which I didn't do, I probably should have done, is to show you that you would be able to see the volatility on these candles is kind of high, so it's hard to see it on the day level with the wicks, but you would be able to see that one ABC. All right, so again, I know that this is a lot to throw at you, so I'm going to show you some examples of trades that I've actually taken with it. Hindsight is 2020. Let's look at some examples in real time. So this one was the 10-year Treasury note futures. As you guys should know by now, that's one of my favorite things to trade. So I did this analysis on that. And as you see, it's not as perfect as some of my examples, but it more or less gets the job done, right? I have 1, 2, 3, 4, 5, and again, this is notice that this is 30 minutes as well. So you have to be prepared on those lower time frames. Remember, we were discussing about how your technicals are going to be a lot more dubious, right, or have a lot less reliability when you zoom in, right? And the same is true to an extent for Elliott Wave, but when you get the hang of it, you actually see the patterns very well, but you need to practice. So this is one that kind of, basically worked. And the ultimate test is if we can base a trade off of it, right? So here I'm expecting this to, retrace. Well, what we saw was it took its time, and it actually, I should readjust this because we did have a little breakout here, but it collapsed, subsequently. All right, and that was because of a data point. A lot of times when you see these, it's because of noise and volatility from algorithms, because these, just like any other technical technique, it's not going to give you the exact point of entry, unlike I should correct myself in that you need a little bit more tools to get that to that level. And the reason why I featured this chart is this was still within the risk management model. So this was next example is AUD against USD, and this is a spot, right? So again, this is even with 1 day granularity. You see, it's still pretty noisy, but I was able to come up with this 1, 2, 3, 4, 5, and then the ABC. And so what I'm predicting here, even though we have this kind of ascending wedge or rising wedge or bull wedge, whatever you want to call it, which would predict a breakout to the upside, The Elliott wave is telling me that perhaps we're going to be retracing, further down here. And so what we see is that. Now, there's an important thing to realize is that this is actually a little bit too low to continue the Elliott wave pattern, but it absolutely cannot continue past here. If we break the base of this, that means that we have a trend reversal. Okay, so it's no longer, I no longer expect after this trade, after I made my money here, I really want to keep my eye here, because if it breaks this, then I'm probably not going to retrace, or if I do, it's gonna take a while. I may see some sideways behavior. Elliott wave is very good for identifying trends and confirming when a trend has broken. That is to say, I see this little bullish period going on here. I see this retracement. When can I confirm that my bull trend has actually turned into a proper bear trend and it's no longer a retracement? And that's with what I just gave you. It's actually, if it breaks past 2, you should be a little bit skeptical. If it breaks past this origin here, which should be technically denoted as 0, but if it breaks past this, we're kind of fucked in that sense. So get out of your long trades if you're in them at that point. And we see that basically here we were saved by the bell, right? We just had a couple more, maybe a quarter of a day's volatility's worth of space between this lower bound here and what would have been certain death here. And we saw that a lot with Bitcoin. I don't have examples here, but I can show you some examples when the frenzy finally, when the Bitcoin, crypto in general, when that frenzy finally popped, we were seeing a lot of these validations of the Elliott wave. So in other words, as a confirmation that the bubble had burst and that we were in a bear trend. So that's all. From here, I move into indicators because what we gave you was the introduction to indicators. There's actually a lot more that I like to cover. They're just a little bit more advanced. You guys have seen that when I did the class on my indicators. Those are actually, if you recognize the Chan demo and momentum indicator, those are mine. So if there's an interest in indicators, we can also pick up with some advanced material on that. But if you guys liked Elliott Wave, I know that's it's a very, again, subjective thing to do. So you really want to start getting practice with it. And before I open it up for questions, I just would really recommend the best way to do this is just look for this structure in the chart that you're looking at. And notice that 3 could be really long, right? That's okay, right? Don't think that they need to be the same size, okay? Just think in your mind how to see these. And I know this might be a little confirmation bias at first, but when you get practice with it, you know what's real and what's not, right? If you're forcing the Elliott wave onto a chart, it's probably not right. If you don't see anything there, that's fine. There's probably nothing there. If you do see it, then you do have really reliable trading guidelines, right, that you can go by. So that's pretty much, we got about 5 minutes. So if you guys had any questions, feel free.
No, not really.
Andrew, any questions?
At the moment, not right now.
No?
Okay.
No.
Okay, so you guys can see how complex this subject is.
Yeah.
And, at the beginning, I told you guys, this is not my forte. I don't use this in my own trading. And because I don't feel that I use it and I know enough about it, then I wasn't comfortable teaching it, right? And as you can see from Danny just covering 40 minutes of this, I bet you guys probably have more questions now, or you're probably more confused or perplexed more so now than you were probably at the beginning of this. Would that be like a correct assumption?
I would say so.
Yeah, I mean, it's a very complex topic, right? I mean, it's something that you go very deep down a rabbit hole, going into this type of analysis. But like I said, there's many different ways to analyze the markets, and there's many different ways to formulate strategies around trading the markets, right? So whatever works best for you is the way you should focus on trading the markets, right?
Yeah, I completely agree, and that's why, you know, hearing the formal theory of it is going to be overwhelming at first, obviously, but the way to start, right, is really just look for this pattern, right? If you could see this, and even better, if you could see these little overlapping, you know, subsets, these fractal patterns, that will confirm or you know, give you confidence that you did the right thing. And of course, you know, you could always reach out to us. Just a heads up, my phone is completely dead, and I'll have the new one will be activated in 24 hours. My point in telling you guys this is that I got locked out of Discord, and of course it's asking me for a confirmation code. So if you've messaged me and I haven't been able to get back to you, it's because I can't get into Discord at all. So that should be cleared up in the next 24 hours, because I really want you guys to practice this and go over these, what you see with me.
That's a negative confirmation bias. It wants you to take a holiday.
I like it. I like it.
Yeah, so as Danny
like
said
that.
earlier, guys, if you guys are interested in further deep analysis in Elliott Wave, in Gann theory, you know, using the cipher patterns, things like that, or using some of Danny's indicators, just let us know and we'll make it happen, right? I mean, like, in all honesty, Elliott Wave wasn't even on the curriculum, so I wasn't even going to cover that subject until Andy mentioned it, right?
Thank you, Chan.
So because you mentioned it, you know, I thought it'd be good to you know, to cover some of this information, and you can see how complex, you know, just technical analysis is, right? And you know, we've you know, kind of like just scratched the surface of technical analysis, and we haven't even discussed financial products or fundamentals, macro or micro, of financial markets, right? So you can see there's many more elements that you need to overlay. And as Danny said, right, our whole curriculum is built upon information that you learned in previous classes, right? And so everything that we've learned from like Fibonacci, you see how Fibonacci was used here.
Yeah.
You see how all the other patterns that we discussed are used here, right? So everything that we've learned before is going to be built upon, right? So it's be very important that you guys keep up and you know, and keep up with the subject, all right? As for next class, on Thursday, we're gonna be focusing on doing the review for the rest of the technical analysis. So we're gonna be covering technical indicators and market profile. After that, we will be moving on to financial products in January. Right. So if you guys have any more interest in Danny's stuff, you know, let me know, or you can just, you know, say it now, and we'll try to fit it in somehow. If not, we're just gonna stick with the current curriculum as it is. All right, guys.
Thank you, Chan.
Thank you, guys.
You're welcome.
Yeah, and definitely let me know if you have any questions about this, or you want to see the other material that was in here that I didn't get a chance to cover. And also, if you still want to look at Gann theory, I can make a point to you know, include that.
Okay. So we'll just do it by popular demand. So if you guys you know, if you guys find a lot of interest and value in Danny's material, just let him know or let me know, and we'll just book another session. But other than that, we'll just stick on the current curriculum as is. Danny's gonna be away on vacation for like 2 weeks anyway, so we won't be able to do anything anytime soon. Anyways. All right, guys.
All right.
Thank you.
So yeah, Thursday we will be continuing class 8 p.m. on Thursday. Other than that, you know, what is it? Are we going to yeah? So I wish you guys a happy New Year's going into the New Year's.
New Year's Eve is tomorrow, so have a happy New Year's. Drink some for me. Don't do anything I would do.
And then I'll see you guys Thursday, or even Thursday. I mean, like, I'll make it to be determined. So I'll reach out to each one of you personally to see where you are, because, you know, some of you might be hungover. So if that's the case, then we will postpone. If like on Monday when you know, Andy and Andrew showed up, we'll just continue the class as is. All right, guys.
All right. Thank you, guys.
Thank you. Happy
All right,
New Year.
man. Have a great night. Happy New Year's to you guys. Stay safe, and we'll see you guys.
Cheers.
2020.
Same to you.
All
All
right,
right, guys.
Again, Danny, enjoy vacation. Be
Thank
safe.
you, man. I appreciate you guys being here. So It's always a pleasure, and we'll look forward to the next class.
Thank you.
All right. See
All
you
right.
then.
All right.
Take care, guys.
Take care,
All right,
guys.
bye.
Thanks, Danny, for
Bye.
helping out.
No problem.
Have a great evening, everybody.
Thank you.
All right. Take care. Bye-bye.